Hello and happy Saturday. Just want to give you a quick update on what the fully loaded Quad 2 portfolio looks like. Remember, Quad 2 and Quad 1 are all for and all about as aggressively within the confines of your risk metrics able to go after returns. Quad 3, Quad 4 is all about protection. We've spent a significant portion of this year both in Quad 3 and Quad 4, and now we're coming out of that. And this is a global Quad 2 type of reflation scenario. I talked about that on my radio show this morning, which you can find podcast at iheart.com, or you can just go to our website, careformywealth.com, look under resources, and then that'll help you identify what you can use because it's in the iTunes store as well. But I talked about the global reflation and the kinds of things that happen within that. One of the things that happens in the midst of a global reflationary type Quad 2 event is interest rates stop going down. This has a significant effect on traditional forms of fixed income. So the kinds of fixed income that we've loaded into the portfolio are those kinds of fixed income pieces that do well in a rising interest rate market. One of the other things that, again, dependent upon your risk measurements, that has a tendency to do very, very poorly in a Quad 2 type growth with accelerating inflation environment is gold. Now, lots of people think that gold is a great hedge and that anytime there's inflation or sniffs of inflation that you want more gold in your portfolio. What gold really looks at is real interest rates, nominal minus inflation. And real interest rates are rising. The argument to that, of course, is that people would say, but yeah, real interest rates are negative. Doesn't matter. What matters in the world of Wall Street is the rate of change, right? Linear movements of math doesn't matter. What matters is the calculus, the rate of change. And the rate of change of real interest rates, although negative right now, is positive. In other words, the actual real interest rate is a negative interest rate. Sounds weird, but again, it's that low interest rate minus a fairly strong inflation number gives you a negative real interest rate. The movement of that interest rate, however, is positive. Gold hates that. So if your risk metrics are allowable, we're short gold, and I think that will do quite well over time. The objective in Quad 2 is to get away from duration and deflation kinds of assets that are very rate sensitive. So we don't want to be in utilities. We don't want to be in rate sensitive type securities, even including real estate. We certainly don't want to be in traditional treasuries or traditional forms of bonds. Again, very rate sensitive type stuff. The things that do well are tech, momentum, high beta. Beta just means, for example, a beta of 1 is the S&P 500. A beta of 2 is some number twice as aggressive, risky, perhaps you'd want to look at it that way as the S&P 500. But interestingly enough, risk is relative to where you are in the quadrant system. Risk in Quad 1, Quad 2 is very, very different from Quad 3, Quad 4. So having an investment in high beta in a Quad 1 or Quad 2 type of a scenario in terms of the rate of change of the economic sine curve, the movement of our economic structure at the time is very, very different. And so therefore having some exposure to high beta is okay. Industrials, materials, things of that nature. So our top 10 positions happen to be things like that. Small caps, tech, NASDAQ 100, industrials, materials, energy, momentum, high beta, all that stuff has a tendency to do really well. In the last few days, we've gotten really wonderful buying opportunities in terms of U.S. equity markets and global markets too, because of what's happening with the dollar, because of what's happening with volatility. Volatility ramped over the last couple of days, giving us some really great opportunities to buy, simply because when we're buying securities, we want to buy them when volatility is high, and then as it's leaking out, and then obviously when volatility gets low, we basically take some profit on that. So let me share with you just a few basic charts real quick, give you some perspective. First one is interest rates. So this is the 10-year Treasury. This line is just my line that helps me to keep track of some basic things. But trend is 0.98%, and it would not surprise me to see interest rates on the 10-year Treasury break out above 1%. If that happens, it's going to be a bell ringer for the U.S. economy in a whole host of ways. And the data continues to support that we're going to see higher interest rates, including and not limited to the most recent jobless claims numbers. You know, when you get bad jobless claims numbers, and the most recent one was worse than expected, you get more stimulus. When you get more stimulus, you get lower U.S. dollar values. The lower the U.S. dollar value goes, the higher interest rates go. And that's simply because higher inflation, you get more of Quad 2. Quad 2, again, is growth with accelerating inflation. And so we expect interest rates to really move, which is why we only invest in bonds in Quad 2 that are specific to those kinds of things that do well in a rising interest rate market. Business development company debt is one that we have a position in. Convertible bond type positions are something that we have exposure to. An investment in an interest rate sensitive bond portfolio that does well as the yield curve steepens. What does that mean? So the yield curve simply is a relative graphic of short-term interest rates compared to the long-term interest rates, say the 2-year rate versus the 10-year rate. The Fed is very actively and artificially holding low ends of the interest rate cycle, the yield curve down, whereas the market controls the long end of the yield curve. So if the Fed's going to hold and anchor that short end in an attempt to try and keep money cheap, and the market says, no, look, inflation is on the way, the dollar's going down, stimulus is happening, all this is occurring, then the long end of the yield curve is going to ramp to the upside, making the yield curve steeper and steeper and steeper. And that's where something like this does really well. And you can see just recently, the movement of that has been pretty dramatic as the yield curve has really, really started to steepen in that regard. And so we have some exposure in terms of bonds there. If your risk measures allow, we are short U.S. Treasuries. And when I say short U.S. Treasuries, that just simply means that it does well as interest rates go up. So you can see recently interest rates have come down. We've been buying our short Treasury positions down here with the anticipation that they do this as interest rates have a tendency to move up in Quad 2, and they can move up pretty aggressively beyond what many people can anticipate. I mentioned that our top equity positions are small caps, along with the NASDAQ 100, along with technology in general, along with a number of different holdings in energy sector as a whole, exploration and production, oil services, a position in oil itself. Oil has been very bullish and continues to signal more bullish kinds of activity in terms of higher lows and higher highs. And within a bullish trend, that is a very, very, very positive thing. Industrials, materials, transports, consumer discretionary, all these kinds of things have a tendency to do really well as Quad 2 on a global scale continues to develop and continues to show itself. So one of the reasons why we've bought really, really heavily over just the past few days is that volatility has continued to break down through certain trend levels and through certain trade levels. Volatility represented by VIX for the S&P 500, VXN for the NASDAQ, and RVX for small caps gives us the opportunity to enter into those markets when those volatility measures start to ramp up. So let me give you a real quick peek at that. So VIX is represented right here, and you can see that in the last 3 days, VIX, that's the short-term one. Let me give you the correct one here. VIX over the last 3 days really started to ramp. Now, trade and trend levels are right at where it hit. You know, isn't that interesting? The trade level for VIX is 25.46. It hit a high of 25.14. Could we see it go a little bit higher? We could, but you can see intraday it started to leak out and come down. And so we were buying heavily into a number of the positions and names I just mentioned when VIX was way up here in the 24, 24.5, 25 range. And then as this starts to leak out and ultimately break itself back down into, say, the mid to high 19s, what we'll do is we'll take some profits, and at that time, if it's appropriate, might even short some things that have really positioned themselves for that. The NASDAQ volatility measurement Interestingly, anytime the NASDAQ volatility hits or comes up close to 30 is a huge buy opportunity. So we were buying at VIX 29, excuse me, VXN 29, VXN 30. And the kinds of positions specific to that would be the NASDAQ 100, technology, things of that nature. And so our anticipation is that VXN volatility continues to leak out and break down. And so we would, again, take some profits down here and then reload when volatility or VXN ramps back up. Small cap volatility is represented by RVX, and you can see anytime it hits 30, a big buy signal is an RVX hit at 30, and then of course we're going to anticipate that it leaks out. The interesting thing and the important thing to remember about volatility is that assets and money move away from asset classes whose volatility measurements are increasing within trend, right? So if we have a volatility measurement like VXN and VIX, which is in bearish trend, which is good for price, then we want to buy when it hits the top of the level of the mathematical range. We want to sell some of those positions, which would be profiting in price, as it hits the low end of the mathematical range. So again, for VIX, that would be down at about 19 and a half. And it continues to signal that it wants to head and go lower. Same thing for RVX, same thing for VXN. It would just be different numbers. It would be back down to the low to perhaps mid-20s that we would maybe take some profits on that. And so that's how volatility works. Asset money, asset division, interest in, all that stuff happens. Money moves towards asset classes whose volatility measurements are declining. Money comes out of those asset classes whose volatility measurements are rising. Treasury volatility has been rising. Currently, the MOVE index, which is specific to the Treasury market, is running about 49. If we look at what MOVE was just a month ago, it was in the 30s. So volatility is coming into Treasuries. As that happens, money leaves, makes it a great short opportunity. As volatility goes down, then money comes in. And so it just is a wash, rinse, repeat kind of scenario. We want to buy at the low end of the mathematical range when volatility measurements are peaking. We want to sell some of that position. Notice I said some, 25 to 50 basis points at a time, when volatility is coming out, hitting the low end of the mathematical range, while price is hitting the high end of the mathematical range. So hopefully this continues to make sense as we go through. We are currently fully loaded for a quad 2 portfolio, meaning we are approximately 92 to 95% invested. There will be some adjustments that I make simply because on a global scale, China's quads have started to shift, meaning they've been moving through quad 1 and quad 2. They're starting to very slowly sniff out quad 3, which is anticipated maybe in Q2 or Q3 of next year. So on bounces, on green, I'm going to be selling out of our Chinese exposure and then pushing that back into the other areas that are likely to do much, much better, like, for example, Russia, India, Australia, Canada, Brazil, those, including Taiwan, South Korea. These are spots that are moving strongly into quad 2, maybe even quad 1 in a couple of instances. And so we want to continue to increase our exposure there as we come out of China. So hopefully this helps to give you some perspective in terms of where we're at and how quad 2 portfolios are continuing to grow and develop. Of course, any questions that you have, please give me a call. Let me know. Always thankful to help you. Always thankful to answer your questions as we continue to help you navigate through this. Thank you so much for that opportunity. I'm super thankful for it. And hope you have an amazing weekend. God bless.